For decades, cap rates have been one of the most commonly cited metrics in commercial real estate. Investors talk about them, brokers lead with them, headlines focus on whether cap rates are expanding or compressing. But as we move into 2026, relying too heavily on cap rates can be misleading and in some cases dangerous. In this video, we're going to explain why cap rates increasingly lie, what they fail to capture in today's market, and why cash flow stability, especially in shopping center investments, will matter far more than headline valuation metrics going forward. Let's start with what a cap rate actually is. A cap rate is simply the ratio of net operating income to value. It's a snapshot, not a forecast. It tells you what the market is paying today for $1 of current income. What it does not tell you is how stable that income is. It doesn't tell you how predictable expenses are. It doesn't tell you how sensitive the property is to shocks in debt, insurance, taxes, or tenant health. And that's the problem. Over the last several years, investors learned a hard lesson. Cap rates moved, sometimes dramatically, but not always in ways that reflected true risk. In some cases, assets with very stable income streams traded at higher cap rates simply because debt costs rose. Meanwhile, assets with fragile income profiles sometimes appeared attractive on a cap rate basis right up until their NOI cracked. In other words, cap rates started reacting more to capital markets volatility than to real estate fundamentals. That disconnect is only becoming more pronounced. As we head into 2026, three forces are making cap rates less reliable as a standalone metric. First, interest rate volatility. Even if base rates stabilize, the spread environment remains uncertain. Lenders are underwriting more conservatively, refinancing assumptions are tighter, and debt terms are no longer uniform across assets. Two properties with the same cap rate can produce very different investor outcomes depending on financing structure. Second, operating expense volatility. Insurance, property taxes, labor costs, and maintenance expenses have all become more unpredictable. A property with cheap valuation metrics but fragile expense assumptions can underperform a higher priced asset with durable, predictable cash flow. Third, tenant durability. Retail's become increasingly bifurcated. Some tenants generate daily, non-discretionary demand. Others are highly sensitive to economic cycles, wage pressure, and consumer pullbacks. Cap rates do not differentiate between these realities, but cash flow stability does. This is where shopping centers offer a powerful lesson. Well-located, necessity-based shopping centers often don't look exciting on paper. They don't promise explosive rent growth. They don't rely on aggressive re-tenanting stories. And they don't benefit from flashy narratives. But they generate consistent, repeatable cash flow. Grocery-anchored centers, medical retail, value-oriented tenants, and service-based businesses produce income that holds up through economic cycles. Even when valuations fluctuate, the income stream remains resilient. And in 2026, that resilience will matter more than marginal differences in entry cap rates. Here's an important point that institutional investors understand very well. You don't realize returns through valuation models. You realize returns through cash distributions over time. An asset that produces steady, predictable cash flow, even if it trades at a slightly higher cap rate, can outperform an asset with higher projected appreciation but unstable income. That's especially true in a market where exits are uncertain and refinancing assumptions must be conservative. We ask a few fundamental questions. How stable is the tenant base? How essential is the use? How predictable are expenses? How sensitive is the property to external shocks? If the answer to those questions is strong, the investment can perform even if valuation metrics move against us in the short term. Cash flow stability also changes how we think about risk. Volatile assets often look attractive during good times because their upside is visible. But during uncertain periods, like the ones we're in now, volatility cuts both ways. Stable cash flow reduces reliance on capital markets timing. It reduces refinancing pressure. It gives investors flexibility rather than forcing decisions. That flexibility is incredibly valuable in an environment where policy, rates, insurance, and consumer behavior can all change quickly. Another reason cap rates can be misleading is timing. Cap rates are backward looking. They reflect trades that already happened, often under financing assumptions that no longer exist. Cash flow, on the other hand, is forward looking. It reflects what the property can actually produce under current conditions. When markets are stable, the difference between those perspectives is small. When markets are volatile, that difference becomes critical. That's why we believe this year will reward what some might call boring real estate. Assets with modest growth but strong income. Centers with everyday tenants rather than trend-driven concepts. Properties where conservative underwriting produces predictable results. These assets may not win every valuation comparison, but they tend to win over full cycles. For investors evaluating shopping center opportunities today, the takeaway is simple. Don't only ask, what cap rate am I buying at? Ask, how confident am I in this cash flow 5 years from now? Look beyond headline valuation metrics. Understand the income. Stress test the expenses. Evaluate tenant resilience. Because in 2026, the ability of a property to keep paying investors consistently will matter far more than what a spreadsheet says its theoretical value might be. Cap rates don't disappear. They still matter, but they are no longer the truth. They're just one data point. Cash flow stability is the signal, and investors who focus on that signal will be far better positioned to navigate the next phase of the commercial real estate cycle. Thanks for watching, and see you next time.